If you're investing serious money, you may not want a one-size-fits-all strategy. If you want more control, this episode's for you. I'm Dean Lulkin, investing veteran and private credit CEO, here to help you grow your wealth. Today, I'll show you how to use Invesco's 11 equal-weighted sector ETFs to tailor your portfolio, reducing overexposure to tech and boosting stable defensive sectors. Now, in the prior episode, we already talked about why equal weighting part of your portfolio makes a lot of sense. So today we're going to talk about how you control risk and align your investments with your outlook without needing 20 spreadsheets. And on the next episode, we're going to tackle global diversification, why the pros rarely recommend it, but you should seriously consider it. Wall Street pros build complex portfolios to justify their fees, but I want you to build smarter, simpler portfolios by controlling sector exposure yourself. Let's be honest. If cap-weighted indexes are dominated by a handful of companies, you could just buy those companies directly. The rest barely matter. Equal weight exposure is harder to craft than manage, especially for individual investors. But it's worth it because it gives you access to the whole market, not just some headline names. So together, let's take a look at Invesco's. Again, this is the only fund business currently doing these equal weight offerings, not because they pay me or I'm somehow biased towards it, but Invesco's equal weight sector ETF lineup looks like this. They've got RYT, that's technology. You got hardware, software, semiconductors. RYH, healthcare. You've got pharma, biotech, and insurers. At RYF, the financials with banks, insurance companies, and asset managers. RCD, consumer discretionary. Those are your retail, autos, and leisure. RGI is your industrials with Boeing, Caterpillar, Honeywell. EWCO gives you communication, and that's Google, Meta, and the rest of telecom. RHS, consumer staples. Procter & Gamble, Coca-Cola, Pepsi, the stocks that really aren't too economically sensitive. RYE, energy. Exxon, Chevron, oil and gas. RYU is utilities, your regulated electric and gas. And finally, we've got EWRE for real estate, those are your REITs, and RTM for materials. Those are chemicals, mining, construction. So what does a custom strategy look like? Well, we can trim back our tech weight from what it would normally be inside of a fund like RSP, the equal weighted S&P 500, using RYT. Instead of having 15% allocated, we might take that down to 10% to further reduce valuation risk. And we can keep our communication services EWCO weight at 5%. Keep that exposure to companies like Google and Meta. Now, I would personally, for me, boost healthcare, RYH. I would move that up to 15% for its defensive and growthy potential. I could raise staples, RHS, and utilities, RYU, to 10% each. Because in this correction to possible bear market environment, you're going to get stable, income-producing results. Why? This tactical shift reduces volatility. It enhances income and better reflects the real economy, not just big tech. Again, I want to remind everyone this is equity-focused. I want you to keep your total asset allocation in line with your personal goals, risk tolerance, time horizon. On the next episode, we'll talk about why global diversification matters and how to add it in really simple ways. Subscribe to the Dean's List now and keep growing your wealth intelligently.